Hello and welcome. You with us here on BTTV. I'm Abhaa Bakaya. And joining us this afternoon is Anand Tanan. But before we go across to him, I'm just going to take a quick look at how we're doing in trade today. Just even in fact, at this point of time, Nifty, if we just bring that up for you, is steady, as is the Sensex at 62,000. We've seen, fresh highs being crossed and consistent trade this week. Really can't complain so far, but wondering which way we're going to see the markets go next. That's the big question. Advanced decline ratio is pretty even as of now. Take you through some of the gainers and losers very quickly, bring them up for you on your screen to get an idea of the action in the markets today as well. And we've got Kotak Mahindra Bank that's looking good on the upside. That's definitely one that's standing out. We've also got other gainers like Dr. Reddy's, Coal India bouncing back today as well. So a couple of those on the gainers list, HDFC, Bharti, HCL Tech, some of the other names there all on the upside. On the losers list, Bajaj Finance, Bajaj Finserv, so both the twins, NTPC is also trending lower, Tata Steel, IndusInd Bank, and let's see, M&M, Ultratech Cement, Titan, some of the others there on the losers list in today's session. Anand, great to have you with us. Let me first come to you on the overall mood of the market, how much you're reading into some of those global cues, how much you're confident on the domestic story, what do you really feel is awaiting us at the end of the year?
Well, the global cues are, while we've had a good rebound in the recent past few weeks, it's not like we are out of the woods yet. My argument is that at least as far as the US is concerned, it's quite clear that we will probably continue to have interest rate hike going into the future, which automatically means that on a global basis, valuations are capped and may actually trend lower. Now that brings us to India, where we've been holding up very well and have done well both in terms of markets and in terms of currency. So from an investor's perspective, anyone looking at India has actually found India to be a reasonable safe haven. And the domestic market has performed exceedingly well even with the domestic flows. The question is what from here, because of the fact that the money is getting tighter, even in India, we've seen that credit growth has picked up dramatically. We are now 16 to 18%. Deposit growth is significantly lower at single digits. Therefore, the credit to deposit ratio is now getting stretched. And consequently, you will find that as cost of credit becomes more expensive, many of the companies will start to show some stress. Right now, because of the larger companies having deleveraged their balance sheets fairly substantially over the last few years, there is some upside possible, and that's what we are seeing in terms of the capex flow. So while you would expect to see earnings growth sustained for at least maybe another 6 months or so, no major pressure on that. There is still a problem in terms of the valuations, and we've seen some of that correcting. But even despite that, the markets are somewhat stretched. And from here on, given the fact that debt markets are becoming a lot more interesting with the yields going up, there is now a case to be made for at least not increasing asset allocation towards equity. And if you are actually overexposed, then you should be looking to reduce the asset allocation.
Okay, a couple of pockets there, Anand. What do you feel is happening to commodities? Is this the time to get back into them, or would you just steer clear altogether?
It depends on which commodities we're talking about. I mean, obviously, if the global economy slows down, things like metals, etc., can't do very well. But because of the supply side shocks that we have seen in terms of fuel and oil, etc., oil, gas, and energy in general, I think that sector will remain under some pressure in terms of the price of moving up. Though we have seen some easing off there, I don't think that can be expected to last, because the cutback in these supplies have also been fairly severe. So overall, while the productive commodities will not be great, the soft commodities, and including crops and agricultural commodities, are likely to stay fairly expensive. And that will mean that at least for India, the CPI is not likely to come down in a hurry, and inflationary pressure will continue to sustain.
Okay, so inflationary pressures continuing there. Where do you feel we're going to feel the pinch of that the most, Anand, when it comes to the markets?
I'm sorry, I didn't get you.
When it comes to inflation, I mean, we were just looking at possibly an easing off, or at least hope that there would be some easing off. If you are expecting that pressure to continue, where do you see the pinch? Where do you really feel the maximum hit is going to be when it comes to the markets?
Well, I think, as I mentioned, first of all, the direct pinch is for anything which is using soft commodities, including food. So FMCG companies will continue to see some pressure. And while they do have pricing power, and the frontline companies have reported good numbers because they've also raised prices. The question is, how far can you raise prices without hurting demand? And I think you're not going to be able to do too much of that. On the other hand, for most of the industrials, you have to remember that the WPI has been at double digits for a very long time, and significantly high mid-level double digits, whereas the CPI has been growing still at 7-8%. Consequently, there is still some amount of squeeze in the margins that needs to be passed on. While we've seen some give in terms of some of the input prices, I think they will continue to have to maintain at least the same level of inflationary output for their output for them to be able to recover margins to where they were earlier. So I think you will find that companies which are catering to a market which is a little more price sensitive will definitely begin to feel a margin pressure, and therefore perhaps some amount of earnings degrowth. Those that are able to pass on because they are dealing with consumer discretionary at the higher end, or for the richer segment, can probably do well. The other challenge, of course, is the exports, because a lot of the India growth story was benchmarked on the fact that because of the government incentives in terms of PLI, there would be a fairly strong export growth. And we've seen that beginning to give up as well. The last few numbers from exports have been somewhat disappointing. And because of the fact that, again, the global market aren't looking all that great, there is a limit to how much the exports can hurt. So both from an export perspective as well as from the market, which is a little more price sensitive, you would expect to see some pressures.
All right, fair enough. Other individual stocks, let's take a look today. Adani Enterprises, any view on that one? It's looking a little weak now. Anand, I don't know if you've been tracking the group companies, but now it's fallen most in a month almost. This is all amid the company getting its nod for that open offer for NDTV.
Yeah, well, the open offer can put some floor, but I wouldn't like to comment on individual stocks, especially one which is not necessarily giving you a parameter to judge valuations.
Okay, that's a fair point. Let's talk about some of the other names that have been catching our eye. Defense has been a theme that continues to stand out. Stocks like an HAL in particular have really been solid in terms of the kind of performance they've been seeing. In terms of the industrials, defense in particular, anything exciting you from that basket?
The industrials have reported very good numbers. If you look at all the capital good companies, most of their numbers have been fairly good. But again, one would argue that at 40 times earnings, even if you assume that you are in a small upcycle, how much more would you pay? And if you are surprised on the upside in terms of the capex cycle lasting for longer than at least I currently expect, then of course there can be some significant upside from here. But overall, my argument is that companies are expanding without necessarily being able to see an across the board increase in capacity utilization. Take cement, for example. Most of the companies have actually expanded capacity. And despite the fact that there is a lot of optimism in the sector, there is no great margin expansion story that one has witnessed at all. And despite that, companies are continuing to expand because of the fact that they think that at some stage the demand supply gap will vanish. So to some extent, I believe that the capex that you're seeing is somewhat driven by optimism rather than actual business sense, and the fact that the balance sheets are deleveraged. So for the near term, at least for the next 6 months, I think the industrials and the capex-oriented companies will remain in a sweet spot. But at some stage, you have to start looking at when to exit. So if the valuations go up, let's say another 20-30% from here, I think it's time to get out of it.
All right, Anand, give me your top, 3-4 names that that you like in the market, but maybe after recent cues such as earnings, outside of what we've talked about, maybe from the broader markets, anything that's catching your eye, if not an individual stock, a trend. There have been certain pockets that have really been looking up, but given valuations like you touched upon, where do you feel there is opportunity for returns in the market?
So from a sectoral point of view, clearly the biggest beneficiaries are the banks, right? For the longest time, the corporate-facing banks have been, except for the last 1 year, haven't done well. The public sector banks in particular have actually managed to clean up their balance sheet and therefore have started to do quite well now. And with the kind of growth that we are seeing in credit, as I mentioned, the NII figures will actually move up. So while the first flush of that movement is already, I think, in the prices, the second part, which is the fact that now that you have to start looking at increasing the deposit growth as well, and therefore those banks which are strong on a deposit franchise, and that is where I would explain moves in HDFC or Kotak, for example, will have to join the party, because they are the ones that have both the ability to increase their loan book as well as the fact that they can continue to have fairly strong CASA deposit growth. So overall, those with a strong retail franchise and the ability to lend to corporates, which essentially means the larger private sector and public sector banks, are a good spot. I think companies which are in the on the wealth side of the business, for example, insurance companies. These are companies which have a very long runway to run, and I think while the valuations are not very cheap, they still have upside going into it. I think IT though it has done well over the last couple of weeks, it has been thrashed quite a lot. I mean, people have kind of gone underweight on it quite substantially, and I think my belief is that the slowest sector to degrow or to slow down, the sector to slow down the last will be the IT sector. And consequently, given that there was some give up, some of those stocks will continue to do well. On the domestic side, and as I mentioned, anything which is dealing with the higher end consumer discretionary is less likely to have supply demand elasticity, and therefore, whether it is SUV based cars or expensive consumer durables, etc., will also, I think, continue to have reasonable demand going forward. So those are the broad themes that I would look for, and within that, any stocks that catch the eye, I think, deserve to remain in the portfolio.
All right, a quick look at Global Health, the operator of the Medanta chain of hotels. Let's just take a look at that and get you the latest there. It soared about 19% on its debut, listing at 398.15 on the BSE and 401 on the NSE. This after the IPO was in fact subscribed almost 9.5, 10 times during November 3rd to 7th. Sakshi's been tracking that, and she spoke to Dr. Naresh Trehan as well on the IPO, the listing and more. Listen it.
It is true that there is a good feeling around the fact that our listing has been successful. It proves two things. The growth story of Medanta as a part of Global Health has been on the back of providing the highest end of multi-specialty care on the same platform by the best of kind of doctors to the patients at as affordable a cost as possible.
True.
So that has actually led to us from going from one facility in Gurugram, which started at the end of 2009, early 2010, to now we are 2012, in spite of 2 years of COVID, that we now have 5 functional hospitals, and the 6th one is coming out of the ground in Noida. So it's been a very steady but very strong growth, because each of our hospitals are like Gurugram is 1,300 plus beds. Lucknow is 1,000, Patna is 650, so Noida is going to be another 550. So we build, for us to be able to give that kind of highest care, as actually it has been recognized by Newsweek International. Also, as for 3 years in a row, they have said or voted us as the best private hospital in this part of the world. So that's a very good feeling to have, the endorsement that yes, people are recognizing that they are getting the best possible anywhere in the world. That is one part. On the back of that, the whole IPO, because it's one of those points in a company's life that you need to become more outward looking, where you can actually grow faster. So the investors actually have also reposed their faith in us, or their confidence in us, that yes, this is a good quality company being run with all the highest ethics and credibility, and also serving the people, which is all very positive from their point of view also. So we are feeling very good and rewarded by the fact that our efforts have been recognized by the larger community, because we had a few shareholders, now we have over 3 lakh shareholders, yes. And they have done what they have done. It is.
All right. Anand, any of these new listings on your radar? Maybe too early to tell, but what's your take as the IPO market continues to remain very busy?
Well, the market obviously is very bullish, so I don't want to comment on Medanta itself, but clearly hospitals is a business that you want to be in. Again, that's one of the everlasting businesses. And as we go forward, I think you'll find more and more corporate hospitals taking over the business, and the smaller standalone hospitals will have to finally merge because they just can't take the pressure, and they don't have the network effect of being able to get more money from insurance and so on. So I think as corporate chains get formed, companies which are standalone will find opportunities to merge with them. And therefore, any corporate chain which is trading at, let's say, a 1.5 crore per room kind of valuation is something that is worth looking at.
All right, Anand, thanks so much for joining us on the show today. A
Thank you
quick
for
look
having
at
me.
some of those other stocks that have been buzzing in today's session. Tanya standing by with a wrap. Tanya?
Absolutely, Abha. First of all, shares of Motherson Sumi Wiring hit the 20% upper circuit today, and also its new 52-week high after the shares turned ex-bonus. Now, experts believe that the strong parent backing of Motherson Sumi and technical collaboration would strengthen the company's foothold in the EV space and new emerging technologies. Also, the shares of Hutco surged almost 14% today after the company reported its numbers for the quarter ended September 2022. Now, the profit was up by 7% on a YY basis to 396 crore rupees. Net interest margin for the quarter also improved. However, the sales were flat. Shares of Global Health, which you just mentioned, also made a decent market debut, and post debut, they were up almost 4% today. On the flip side, we have Nykaa. Now, Nykaa shares took a beating today. The shares were down by almost 9%, and the stock is under selling pressure after the bonus shares got listed on the exchanges. Now, experts believe that the selling pressure is likely to continue going forward as well. Lastly, shares of Adani Group were also among the top losers. Adani Enterprises, Adani Ports, Adani Power, they were all down to the tune of 3 to 4%.
Thanks for that, Tanya. So there you go. That's the setup today. It's been looking pretty good. No reason to complain as we hover at those high levels. Nifty 18,404, Sensex 61979 as we wind up for the day. Pretty even in terms of advanced declines as well. And, we're just waiting to see if there are any further cues the market picks up as we go along. But otherwise, a healthy day in trade. Some pressure on commodities. Banks, select banks were definitely trending higher. Just as we're about to close, it seems that the Nifty is tossing up on whether to stay in the green or not. Perhaps some last minute selling coming in, but still very much above the 18,400 mark. We'll wait for that settlement to happen as markets shut shop for the day. But overall, a solid session. And we'll go through some of those gainers, losers for you as well. Kotak, HDFC, Coal India, some of the gainers in today's session. While we had the Bajaj twins, some of the commodity names lagging behind. Union Bank, as you can see there, also was trending higher. Finolex was much higher. Great listing coming in from Global Health. So some of these names stood out in the session overall today. That's all from us for now. Thanks so much for watching.